Today we'll be discussing the consumer discretionary versus consumer staples ratio. Now I know that's a lot of words, but what does this actually mean and how can you use it to spot when the stock market is in more of a defensive or offensive positioning? Or maybe another way of saying this is, how do you know when this tool is suggesting that the market is more risk on, people are more willing to buy stocks that are higher growth, higher risk type companies, or where people are more defensive and want to take a posture that is buying the safe and steady stocks or even getting cash overall? In this video, I'm going to describe what the consumer discretionary versus consumer staples ratio is and how you can use it to spot market environments. So first up, let's define what we actually mean by consumer discretionary or consumer staple stocks at all. Well, first of all, let's talk about consumer discretionary. Now, a cheat code for what I'm about to tell you is that we can kind of call these types of stocks our wants, right? Things that people want but don't necessarily need. And consumer staple stocks are going to be companies that sell a product that is more of a need rather than a want. And so as we get into this, I think the easiest way to think about this is to start listing some examples of quote unquote want stocks. For example, Tesla, Starbucks, Amazon, Nike. These types of companies are companies that typically thrive when the consumer is doing great and spending a lot of money on things that they don't necessarily need per se, but rather they want. When these types of stocks are doing well, typically the environment that they're in is very, very good. Now, I do want to clarify that when these types of stocks are doing well, typically most stocks are doing well, including consumer staples. But this ratio helps us to spot something really unique. When everything is good, most stocks typically go up, including the consumer staple stocks. Let's now draw some examples of consumer staples. Some simple examples for this one would be the Coca-Cola Company, Walmart, Procter & Gamble, and Colgate toothpaste. Now, what you'll notice about these companies is they're significantly more boring than the first ones. Tesla, Nike, and all that stuff is really exciting, and people love those types of stocks when the stock market is hot. But they hate those things when the stock market is not hot. And actually, some of these consumer staple companies that we've just listed over here, while they may not particularly be super attractive when the market is hot, they are very attractive when the market is scared and wants to park money in something that is a little bit more stable. Let's now give some criteria around what discretionary versus staple type companies typically look like. Consumer discretionary companies are exciting because they typically have a large amount of growth. These types of companies can grow their earnings significantly year over year and can very rapidly expand to new markets, and their product can go viral essentially. The drawbacks of consumer discretionary companies is that with all this growth, their revenues are not necessarily as concrete, solidified, or sort of steady as the consumer staples. So again, a pro for consumer discretionary type companies is they have a lot of growth, given that the environment is good, and the drawback is that their income or growth can be a little bit inconsistent. Now, typically, consumer discretionary companies are also priced very expensive. Analysts and traders and investors typically apply a high premium and pay big bucks to buy this company for its prospective growth. Now let's talk a little bit more about consumer staple type companies. The pro with these types of companies is that a company like Walmart or Coca-Cola has very steady and consistent overall net income. While these companies might not grow by 30% per year in terms of their revenues, they consistently put up good numbers day in, day out, month in, month out, year in, year out. Overall, the point is they have steady overall upward trending revenue. Here's a quick example on the consumer staple side. This is Procter & Gamble. They make some really boring household goods. Overall, very consistent profits and revenues. Another example is Walmart, which has very consistent revenues, but doesn't make a huge profit margin on what they do, but they do massive amounts of consistent revenue over time. And maybe the classic example is the most classic drink of all time, Coca-Cola, which I'm way too much of a fan of. But the point here is that we have really slow and steady grinding overall trending up revenues and net income. While this company might not be doubling its revenue every year, it has a consistent basis that investors love, especially when times are a little scary out there and people just want that safety and security of buying into a company that is likely to continue to grow slow and steady whether the market environment is good or bad. Now, an ETF that I want to show you guys is the XLY. Now, the XLY is a consumer discretionary ETF, which just means it's a basket of all sorts of different companies. Here's a quick look at some of the holdings. You can see Amazon, Tesla, Home Depot, Booking, McDonald's, TJX, Lowe's, Starbucks, Nike, DoorDash, companies that are a lot of times more of people's wants and things that people buy more of and do well during a time where the overall economy is looking good and company earnings across the board are doing pretty nice. Now, don't let this confuse you. Companies like McDonald's kind of ride the line of being in between a consumer discretionary and a consumer staple, but more examples of just same thing with Amazon, by the way, kind of falls into that category. People are still going to be buying stuff off of Amazon in up times or down times. But companies like Starbucks, for example, Tesla, Home Depot, these are examples of stocks and companies that really require the environment to be good for people to be spending. If there's a huge recession, people are probably not spending a whole bunch of money renovating their homes. They're trying to pull back on spending. People are probably not going to go spend $37 for a coffee at Starbucks. I know that's a little exaggeration, but give it a few years, it'll probably be $37. Nike, people buying the most expensive shoes, or DoorDash ordering in. These are things that people would cut if they needed to in a recessionary environment. But during good times, these companies are growing fast and doing real strong. So this ETF tracks essentially a basket of those types of companies. We could also take a look at the XLP, which is the Consumer Staples ETF that tracks a whole bunch of boring companies. We've got things like Costco, Walmart, Procter & Gamble, Philip Morris, which is a tobacco company, Coca-Cola, not sure what this is, Pepsi, Altria, Colgate, and Target. Most of these companies are things that people are still going to be spending money on, whether the sun is shining, whether it's raining, whether we're in a recession, or whether we're in the good old days. The only problem with the good old days is it always feels like you never know the good old days are the good old days until they're over. But typically when the markets are in the good old days, these companies also still do well, but they don't grow nearly as fast as those consumer discretionary companies that we just got done talking about. But when the market turns for the worst, these companies typically hold up pretty well. And now that we have an overall view of what these two things are, let's now finally return to our XLY versus XLP indicator here. Essentially the discretionary versus staples ratio, or like I like to think of it as the wants versus need ratio. What you'll notice is that when market turbulence is high, this actually starts to typically trend lower as people move money from high-risk companies to low-risk companies. We see that here in the sell-off that we saw in 2025 in stocks, as people were pretty fearful about all of the tariff stuff that was going on and whether we were going to enter a recession, and people started gearing up for the worst. And we see the indicator here suggesting that a flip in sentiment actually occurred pretty early. You can see that when this thing started to trend lower, that was actually a signal that market participants were starting to favor getting into safety stocks rather than aggressive growth stocks. And so we saw a downtrend here. We've since then returned back into a more aggressive and growth-oriented focused market, or a risk-on environment. A way to think about this is typically people are more willing to take risk when the environment looks good, and they're not willing to take risk or want to diminish their risk when times look ugly. So the way I like to use this in my trading and in my investing is recognizing that if we're looking at this thing from a momentum trending trading perspective, I like to be trading in the direction of what we're seeing here. If we're trending higher on the discretionary versus staples ratio, to me, that suggests that overall we want to be more oriented towards buying growth companies and of course keeping a close eye on things that could potentially turn. If things are looking ugly out there, I'm typically going to, from a trading perspective, be aligned with that until something shows signs of a reversal. Now, the final way that I really like to use the consumer discretionary versus consumer staples ratio is actually a longer term indicator. So here we go. This is probably my favorite way to use this. When this thing starts to get very high, you can see the legend on the left-hand side. Over time, we're plotting this. And when this gets higher, right, when you start to see high extreme levels of this indicator being printed, it may be more of a suggestion that the market is starting to get a little bit euphoric or frothy. And when this thing gets really low, it could be an opportunity to start looking for longer term overall buys on some of the growthier stuff. In fact, you can kind of use this indicator as a contrarian one. When the overall ratio starts to get stretched to the upside, maybe we want to stack more of the defensive type names in our portfolio. And when this starts to get stretched the other way, maybe that's our time to take a little bit of risk, almost using this as a longer term indicator of potentially the market's sentiment getting too stretched one way or the other. That is why this is under the sentiment and positioning tab within the stock box. We have many different tools to help track market sentiment. And so if you're interested in getting access to the stock box, I'll leave a link in the description down below. It's a tool that we're constantly updating and building more for stock traders to find better opportunities in the markets through more analysis. Thank you for watching, and I hope this video was helpful to you, and we'll see you in the next one.